Hey, Spencer.
Hey, Julia.
So the other day we were talking about socially responsible investing, basically when investors prioritize or they limit their investments to companies that fit some guidelines, some values that the investors think are important, like being environmentally sound or supporting human rights, supporting diversity, that sort of thing.
We're not violating human rights.
Or, right, not violating human rights, sure. Lower the bar a little. And so you said something interesting. You said that you didn't think that the impact of socially responsible investing was as big as people think that it is. Do you want to elaborate on
Specifically,
that?
I was talking about stock market investing, because there are actually funds out there that make the decision that they'll only invest in companies that satisfy certain socially responsible criteria.
Right.
But I think that the effect of that is a lot less than many people imagine.
Okay, so the typical argument for socially responsible investing is that it rewards the companies that are, being good. I guess if you're buying stocks on the open market, you're not actually giving money to the company. You're just paying, the previous owner of those shares that you're buying. But still, even that, shouldn't that raise the price because you're increasing demand for the shares? Yeah,
that's right. So the money doesn't go to the company itself if it's trading on an exchange like New York Stock Exchange.
Right.
The money you use to buy those shares just goes to the person who owns those shares. And it does actually increase the price a little bit, because what's happening is if you go and buy it, whereas you wouldn't have otherwise, then you've created a little more demand for those shares, and you've ended up removing one of the sellers that you wouldn't have removed. And this does have a little bit of upward price pressure.
Which is good for the company, right?
Yeah, so there's two questions here. First of all, how big an effect is it? Right. And second of all, how does that benefit the company? So as to the first question, I think that the effect tends to be very, very small in general. How big it is going to depend on how many shares you're buying compared to the sort of liquidity or size of that company. If you're buying a company that's huge and you're only buying a very small number of shares, and there are a lot of people trading it, you may have effectively no impact on the price. Whereas a much smaller company with a few people trading it, you might have a larger impact on the price. So first of all, there's that question. Then there's a question of how much does it matter? And there are some ways that a company benefits from having a higher stock price. For example, if they decide to sell more shares in the future to the market, they might be able to get a little bit more money for those shares if they decide to do that. A lot of times companies don't do that, but they also might be able to get maybe better credit agreements if they want to borrow money, for example. Yeah. Sometimes in those credit agreements, they use the stock price as part of the analysis of how much money to lend them or when they can borrow money, things like that. So there's some benefits, but I think that the impact on the stock price tends to be so small, and those benefits tend to be fairly limited, such that there isn't a lot of net positive benefit to the company.
Okay, so what about the ripple effect? If other people are going to be more inclined to buy the shares if it looks like the price is going up, and that therefore the company is more valuable.
Yeah, I mean, this is a little bit more complex, and it depends on what sort of trading strategy people are using. I mean, sometimes when prices start rising, people use that as an indication that they might continue to rise, sort of a momentum style. But other people view these, say, if a company suddenly rises in price, they might actually view this, in some cases, as a statistical anomaly and assume that this stock price might mean revert. So that actually might cause them to short the stock or bet against the stock. So it's sort of, people's reactions to the price increase are complex.
Right.
And it's not so easy as just saying that when the price jumps, they're necessarily going to want to buy more or anything like that.
Right. Another thing I was wondering about, if you cause a price increase when you purchase shares of a company because you're increasing demand, then what about when you sell those shares? If you sell them in the future, isn't that going to just cancel out the positive effect you had?
Well, so when you go sell them in the future, that's going to put a downward price pressure that very likely, well, at least on average, is going to undo the effect of what you did originally.
Right.
It's still the company's price might have been on average higher than it would have been. It just is going to end up stopping in effect when you eventually do sell those shares, which you very likely may do not because the company became unethical, but because maybe the investment thesis didn't work out or did work out, and you want to get out of that position. So But there's also this interesting question as to what would happen if actually there were a lot of these socially responsible investors out there. Because you might say, okay, maybe the effect is quite small in the individual case, but maybe if we had a lot of people doing it, that would have a very positive effect. And this is actually, I think, quite interesting.
Because funds that do socially responsible investing are very public about. I mean, they use that as like a selling point for their fund. They boast about it. I mean, they tout it. So you would think that that would help, convince other people that this is the virtuous thing to do, and so it would actually spread faster.
Right, and not just the virtuous thing to do, but maybe the consumer-friendly thing to do. If your clients want you to be socially responsible, then maybe you can even get more clients if you were.
Right.
So then you ask the question, well, let's say a third of people in the market, a third of the dollars in the market belong to socially responsible funds or individual investors.
Right.
In this case, we would say, oh, well, look, they're going to be avoiding buying relatively evil companies, and they're going to be putting more money into the relatively good companies. And this is going to put an upward price pressure on the good companies and a downward price pressure on the bad companies.
Right.
And that's true. However, what this means is that, in fact, the bad companies are going to tend to look like better investments because they're actually going to be at a bit of a deflated price. And the good companies are going to tend to be at a bit of an inflated price. So the good, or morally good companies, are going to be at a bit of an inflated price because they're going to be putting money into that they wouldn't have otherwise. And so actually, the other 2/3 of the market in this thought experiment that only cares about how much money they're making, and that's their only consideration, they're actually going to tend, because of this, to prefer buying the evil companies. Because those are actually, this effect will cause the morally good companies to actually be worse investments. So it actually incentivizes them to do more evil investing. So there's this weird effect, and it's not totally clear that overall there's actually any benefit that's had.
I see. So
it's not clear there's a lot of it anyway.
Okay, so that effect is the effect you're describing here of widespread socially responsible investing would be that the large number of people investing only in socially responsible companies, or taking their investments out of the socially irresponsible companies, those investments would be compensated for by the rest of the market who would be buying more shares in the socially irresponsible companies, and that effect would counteract the effect of the socially responsible investors. Yeah,
it's not clear it would counteract it fully, but basically it would make the more evil companies into better investments because you could buy them cheaper, but only because they were evil, not because they were worse investments.
Got it.
So it's this weird counterintuitive result.
Interesting. So do you think that the funds the private investors, the funds and the institutions like universities that tout their socially responsible investing, do you think they're aware of this analysis that you're giving, that it doesn't, that the effects are going to be small or transitory or counteracted by other negative effects? Is this just a public relations ploy, or do you think that they think they're having more of an impact than they are?
Well, it's a good question. It's hard to say exactly what they think, but it actually hinges to a certain degree on your ethical views. If you take the ethical view that all that matters is how much you help or harm, then I'd say that the socially responsible investing in this space of stock exchanges, for example, is not going to be that helpful. But if your view is that it's evil to support something evil, even if you're not actually helping them cause more harm, but it's just evil to even put your
symbolically support.
Yeah, symbolically support. Then you'd still conclude that it is indeed evil to invest in evil companies, even if you're not having a real impact on their behavior.
Okay, so for someone who wants to reward socially responsible companies and punish socially irresponsible companies, how can they actually have an impact if not through purchase of shares?
Well, there are definitely other things you can do. I mean, let's say you're managing a fund. If you're investing not in the secondary market like the New York Stock Exchange, but let's say you're buying shares directly from the company. Either the company is just going public, right, or the company is issuing new shares, or maybe it's a private company that's selling shares. In that case, the analysis is actually quite a bit different. Because in this case, the money that you use to buy those shares goes directly to the company itself. And then they can put that to use. Now you have to take into account the fact here that there's maybe someone else who would have bought shares if you hadn't. So the only effect you're having now is the differential between what you are willing to pay and what the next person's willing to pay. But still, if that differential is big, if you're paying a lot more money than the next person who would be willing to buy would pay. You're actually giving the company more money, and they could use that for operations, either to do more good or to do more evil or whatever it is else that they do.
Right, and I would think that purchasing their products would have a more direct impact on rewarding or punishing them as opposed to purchasing their shares.
Right, purchasing their product or funding businesses based on whether they seem like they have a potential to do good. That
would be a huge impact.
Because some companies never achieve funding, and if you were to fund, say, a good company that wouldn't have gotten that funding otherwise, that could have an enormous impact. If the company ends up working out and actually is able to achieve its effective good that it's trying to.
Right, right.